If I was starting investing from scratch in 2026, this is what I'd actually do as someone with a six-figure portfolio at 22. And no, I wouldn't start by trying to find the next stock that's going to explode. I'd start by setting up something simple that I could actually stick to for years. First, I'd look at my own situation. If I had credit card debt or money I knew I'd need soon, I would deal with that before going too hard into shares. If this is money you might need in the next couple of years, there's nothing wrong with keeping more of it in cash. A high interest savings account can make sense for people who want stability, want easy access to the money, or just know they're going to panic the second the market drops 15 or 20%. Once that's sorted, I'd open a simple broker. If you're in the US, something like Robinhood is easy and it supports recurring investments. If you're in the UK, Trading 212 has Auto Invest. If you're in Australia, I'd look at something like CommSec. And if you want a really simple ETF only option, CommSec Pocket lets you start from $50 and set up automatic fortnightly or monthly investments. Then I'd automate it. This is one of the biggest things beginners miss. You do not need to sit there every week trying to get to the perfect day. Just set up a recurring transfer from each paycheck or once a month and let the investment happen in the background. The less room there is for hesitation, the better. If your platform supports recurring buys, use them. If it doesn't, at least automate the cash transfer so the money is ready to go. CommSec Pocket supports automatic fortnightly or monthly investing, and CommSec also supports recurring investment on international shares. As for what I'd buy, I'd keep most of it very boring. I'd put 70% of it into VOO. That gives you exposure to 500 large US companies in one ETF. The fee is just 0.03%. Vanguard's fund sheet shows 14.78% average annual returns since inception through the 31st of December 2025. That does not mean you should expect 14.78% every year from here. Markets don't work like that, but it shows you why broad US index funds have been such a strong long-term core holding. Then I'd put 15% into VAS. The reason is simple. I would not want my whole portfolio riding on one country forever. VAS gives you exposure to the S&P ASX 300, so you're holding a broad basket of major Australian companies, and Vanguard lists the management fee at 0.07% a year. For me, that home market allocation just makes the portfolio feel a little more balanced. Obviously, you could swap this out with any kind of global ETF, but I chose Australia because I live in Australia. Then the last 15% is where your own situation starts to matter more. If you're pretty conservative or you know you might want the money sooner, keeping that piece in a high interest savings account is completely reasonable. Cash is not exciting, but it gives you flexibility and helps you sleep at night. If you've got a higher risk tolerance, this is where you can put money into individual stocks, crypto, or some mix of both. For me personally, I'm accumulating Ethereum at the moment because I think parts of crypto still look discounted. That does not mean everyone should do that, but if big swings are going to make you sell at the worst possible time, you probably should not be using that bucket for crypto. And if you love researching businesses, this is where individual stocks can make sense. Just keep the speculative stuff as the smaller part of the portfolio, not the foundation. That's really the whole idea. Build the core first, add the fun stuff second. And if your goal is to build towards something like $100,000, this is where consistency matters way more than trying to look smart online. For example, if you just start with $1,000, then invest $500 a month and earn an average 8% a year, you get to about $100,000 in 126 months, which is about 10 and a half years. Keep going to 12 years and you're at about 122,000. That's not a promise, that's just simple compounding. But it shows how fast things can build when you stop overthinking and you just start investing. So if I was starting in 2026, that's what I'd do. Open a simple broker, automate the money, keep most of it in broad ETFs, use a smaller slice for higher risk ideas if they actually fit your personality and your goals. Because the people who do well usually are not the ones making the most dramatic moves. They're the ones who set up a solid plan, keep showing up, and just give it time. If you want more simple videos on investing, stocks, ETFs, crypto, building your portfolio, subscribe. I'm posting more of this every week. Thanks. See ya.